When you see a company with 110% dividend yield, it makes you wonder, is this an EPIC dividend or a dividend trap? By popular request, we're going to dive into the stock ZIM. It's a shipping cargo company based out of Israel. And while it was founded in the year 1945, interestingly enough, it only went public on the stock market in 2021. Now on this one, I'm going to remain neutral. I'm going to give you the facts. I'm going to show you the reports. It's up to you to be the judge if you like this stock or not. By the way, if you like investing, personal finance, and dividends, consider subscribing for more. First thing we need to look at is how ZIM has been able to afford this incredible dividend rate. Looking right here on the dividend tracker, it's pretty darn sexy to look at 110% dividend yield. And in fact, this April, they paid out a $6.40 per share dividend. But that's the first thing we need to talk about. It's going to hurt some investors that bought into ZIM because a lot of people were talking about it. A high 100%, even 90% dividend yield is quite attractive. So a lot of people went over. They went in and they bought into ZIM. But let's take a look at the average price. If we go over to Seeking Alpha, one of my favorite investing tools, and we pull up ZIM, you're going to see that when they paid out their dividend on April 4th, a sharp decline in the stock price. Now, that is typical when they pay out a dividend that the stock price will come down, but I like to look for companies that kind of maintain a fair and reasonable stock price after they pay their dividend. That tells me that there's a lot of confidence in the company, that people aren't just chasing the dividend and then pulling out after the dividend's paid. And I want to make sure that they have enough cash to continue to grow their operation. So that is a little bit of concern. But if we look back here, and actually let's go to year to date, let's go to the 1 year. You can kind of see how this has been trending. But let's say you bought in right around this point, and you're looking at all these different stock prices, and let's say we're going to average about $21 a share. That's what you bought in on ZIM, and you only bought 5 shares of ZIM. So I'm going to pull up my Excel document. We're going to take a little peek about what this looks like. So if your average price is $21 per share, that's what that indicates right there, and then we bought 5 shares of ZIM, we would have paid a total of $105. Now the goal with most stock purchases is you want the share price to go up over time, and then your $105 turns into so much more. But then of course this one pays an incredible dividend. So what you could do is reinvest the dividend back into buying more shares of ZIM, or you can not reinvest the dividends, keep that money and go buy a beer with it. It's your call. But then we plug in that $6.40 last dividend that they just paid out. So if you bought 5 shares of ZIM in the last couple months, that means you have a total of $137 in that case. That's if the price remains at $21, you get the $6.40 dividend, you have about $137 of value, all right? But that's not what happened. In fact, if we look over at Seeking Alpha, you can see the current price of ZIM right now, as of the recording of this video, is $17.03 per share. That's as a result of that stock price going down after the dividend was paid. So if we plug in $17.03 times $5 per share, your value is now only at $85. But we'll take that $85, we'll add the dividend back in. That means your total value is sitting at $117.15. So that's the one thing. If you bought this particular stock at that high or at that average price of about $21 a share, you're not looking good even after that amazing dividend. And that's something as investors we should keep our eye on. Even though something pays a great dividend, keep an eye on the overall facts. Again, not saying this is a bad company. In fact, we're about to dig into their financials, so stay tuned in just a minute for that. But when it comes down to, I'm going to chase this now because everybody's hyping it up, big dividend is getting paid, are you actually getting the payoff? In this case, if you would have taken this strategy, you're not getting the payoff because it only grew to $117.15. If we scroll back even further, it's actually not a better picture. Coming back here to 2021, it actually peaked all the way up here. You can see, even if you average a $67 per share stock price, that hurts even more, even considering all the dividends paid. But let's hop back to the dividend tracker, and it has some very good interesting information that we can then look at another report that I'll share with you in just a second. So right here on the right-hand side, you see that free cash flow? Take a look at that. Now that tells us a lot about maybe why they're paying such a great dividend. And this is a good thing. This is a good thing in the case of ZIM. Their free cash is going up. Look at that. In 2021, and then in 2022, what a significant increase in free cash. So they have all this money coming in. They're making all this profit. They're making all this revenue. And they're passing it on to the investors in the form of a dividend. In that case, that's kind of awesome. And if you look here at the dividend payout ratio, that is a percentage of their profits paid out in the form of dividends. We want to see that well below 100%. They're only paying out 44.1% in the case of their payout for the dividend. Now remember, if they're paying 100% or more, they're actually paying out all of their profit and maybe even tapping into their cash reserves to pay out dividends. In this case, according to Dividend Tracker, that's not the case. So what caused this sudden rush of cash? Well, a couple things. Anything that has launched in 2021, I now look at with a magnifying glass. And the reason for that is in 2021, post-pandemic, we have a lot of stimulus money flowing in. We have a lot of companies going public. There's a lot of demand. There's a lot of push. And all of a sudden, everybody was just seeming to be flushed with cash. You remember the days of GameStop, AMC, let alone the fact that Robinhood, Coinbase, and of course ZIM launches a stock in that year. It's always good to see, are they just doing it because there was a hype at that time and now they got to make up and actually show if they have what it takes to survive a recessionary period or even just a boring period? That's something we got to keep our eye on. So let me show you this very interesting report. Let me introduce you to something called the World Container Index. This is the cost of containers basically for shipping. Look up here, even in May of 2022, what a difference that is at $7,728 on the World Container Index, now dropping all the way down here to $1,710. What a significant difference. And what that means is that ZIM is going to have to be very careful because the profits and the revenue that they were seeing, which I'll show you in just a second, will not be as strong as it was in 2021 and 2022. So remember how people wanted new cars and people wanted used cars and people wanted supplies to build homes and people just wanted toilet paper. Well, you couldn't get anything because the shipping took forever. And on top of the fact that the shipping took forever, there was just a demand and the supply didn't actually meet the demand. So things were crazy. So as a result, there was a significant push on shipping companies to deliver, and they had to deliver much quicker. So thanks to ZIM, they're able to take their shipping services and go absolutely crazy and make a ton of money. But here's where things get tough. Now that things are settling down, now that demand's coming back down and leveling with supply, there's not as much push for that accelerated shipment. So one thing you should keep an eye on if you're interested in ZIM or you're an investor in ZIM is how they're going to react to these rates as things go down, as revenue settles down. How are they going to hit potentially a net loss and deal with that net loss, or just in general, less revenue? Hopping over to Seeking Alpha. Again, I've mentioned it before, one of my favorite, absolute favorite investment research tools. If you come up here to financials and we click on that, that's going to give us a little bit of a better example of what's actually happening here. We're going to start with their income statement. I'm going to leave it quarterly. But one thing that I like to look for is increase in revenue and increase in overall profit. But this is where things get interesting for ZIM, because look at this. The revenues are actually going up, keeping in mind the World Container Index, 1.0, 1.3, and then coming all the way back up here in September of 2022 to 3.2. But we'll see that in December 2022, it dropped back down to 2.1. Could it be going back down here into maybe even potentially right after the pandemic or pre-pandemic? And if so, something to keep your eye on. Same thing with the profit. As profit goes down, let's say profit dips back down here to June of 2020. So if that happens at only 171, or let's say they were doing good pre-pandemic and they were only making maybe $800 or $1.3 million, that is a big difference in profit from the 2.1 and the 1.9. And their operating income as well, something to keep an eye on. So as we get future quarterly reports, and I would really look into, quarter one and quarter two of 2023. I think these next two quarters, as ZIM reports their revenue, their operating income, and their net profit, that's what I'm going to be zooming in on to see, are they able to maintain their success despite a little bit of a cooling in the market? The next thing we can look at is the balance sheet right up here. It's the second option under financials. I will tell you right off the bat, not to waste your time, their balance sheet looks fine. So that means assets always should be higher than liabilities. Liabilities is like our personal debt. So if you sell everything, will you still have extra cash left over? In the case of ZIM, they would. They sell everything, satisfy all their debt, they'll still have cash on hand. That's resilient. That's a good sign of a good company. The last thing we can look at is their cash flow. And this is also very interesting just because we need to look at what's happening to net income. And this is what I was mentioning earlier. So we're looking at the container index. Container index is going down. Demand is cooling. And as a result, look at their net income. So it's looking great. It's scaling up, as I mentioned, as a result of the demand that happened in 2021. But now, down quite significantly in their last quarterly report of December 2022. Take a look at that, 414 compared to September at 1.1, compared to December of the prior year at 1.7 in net income. That's what's going to really challenge their dividend in the future. Now, they can continue to try to pay high, but then we need to keep an eye on their dividend payout ratio. Are they going to try to continue to attract investors as a result of a high dividend? In that case, they're going to have to tap into their balance sheet and pay out of their cash reserves. Not a good sign. That would be a red flag. Another thing you could also do is go over to charting. By the way, it dropped now to $16.96 as of the recording of this video, which is on April 10th of 2023. But regardless, let's go to charting here. Another thing you can do, of course, comparing to the S&P 500 probably isn't a fair thing. I'm going to go to total return, so that way we can factor in the dividends. So total return looks like this, and I'm going to add a comparison of SBLK, another dividend stock that I mentioned that's very similar to ZIM earlier on the channel. You can go check out that video after this one if you'd like to. So you can see Starbuck is actually kind of trailing with the S&P 500, the total stock market of the top 500 companies. That's indicated by this purple line. S&P 500 is the blue line, and ZIM is the orange line. So we can see that, as a result of right around August, it's been kind of trailing off and slipping away from the benchmark of I would say its competitor as well as the S&P 500. Let's go back over the last 3 years just to get a little bit more scope. And you can see it was doing great back when I said it was back in the early part of 2022 and the late part of 2021. But then, of course, right here is that inflection point. And we're going to have to see what happens to this thing over the long period of time. In the short term, the thing looks great. In the long term with the dividend, that's what I want to keep my eye on. Let's start a conversation down in the comments below. And by the way, if you want to see how I actually analyze stocks before I buy them, there are 10 steps I look at. Check out all 10 steps in this video here, and we'll see you on the next video.